Most people believe that we are living through a global financial crisis 2.0, and the only solution to the 2023 banking crisis is simply more of this. That's right, money printing. And funny enough, I actually thought the exact same thing until these recent comments and predictions by this billionaire completely changed my mind.
Fed lied, banks died. Trust the Fed, end up dead. Every institution that bet big on U.S. government bonds in mid-2021 is a dead man walking. All of this alchemy and abracadabra mumbo jumbo is meant to make a simple thing complicated. So the simple thing is, in 2023, it's not just a financial crisis, it's a fiat crisis.
So this 4.5-hour Balaji Srinivasan interview was fascinating for a number of reasons, and today we are going to discuss 3 of those reasons that suggest to me that the 2023 banking crisis is far from over and it is nothing like the 2008 global financial crisis. So the first reason that this is really counterintuitive is the fact that all of the data today suggests that we're living through another banking crisis. We can see here that the size of the banks that are collapsing today in 2023 are far larger than the banks that collapsed in 2008. And the timeline of the collapses today in 2023 is actually mimicking the 2008 global financial crisis timeline nearly exactly. In the past 90 days alone, of course, we saw the $200 billion Silvergate bankruptcy. We saw the $6 billion Silicon Valley, the $110 billion Signature Bank bankruptcy. We also saw the $90 billion giant in Europe, Credit Suisse, have to actually be bought up by UBS. And of course, we saw most recently the $213 billion giant First Republic Bank recently forced into bankruptcy. So the data and the timelines are very similar today in 2023, but what's really interesting is the Fed today is actually already doing a quasi version of QE, and that is, of course, the BTFP program, where they are actually supplying liquidity to these banks. So this is kind of one of the reasons that is suggesting to me that this time could, in fact, be different. Today, the Federal Reserve is acting more proactively. So it's doing things like BTFP, which is kind of like doing QE before all of the collapses happen. This is very different to 2007, 2008, because all throughout 2007 and even the first 9 months of 2008, the Fed was doing absolutely nothing. It didn't care. And we saw bankruptcies and we saw the housing market start to downturn for those 18 months. And the Fed only reacted when we had an enormous wave of bankruptcies in Q3 2008. Remember that date because that's a very interesting one. We always seem to see a lot of chaos in the banking system in Q3 and all of these other financial crises. We're going to talk about that a little bit later, but let's get on to the second reason for why I believe this time could potentially be different. So in the 2008 banking crisis, we saw global cooperation. So central banks all around the world all collectively dropped interest rates to pretty much zero all around the world, and they all began absolutely flooding their financial markets with liquidity. So obviously we have balance sheets here from the Federal Reserve, the European Union, the Bank of Japan, and the Bank of England, and we can see something very similar amongst all of these different balance sheets. They were all going up and to the right, okay? Printing was happening all around the world, and everybody was collectively lowering interest rates, and everybody collectively was kind of okay using the US dollar as that global medium of exchange and also kind of using it as that global savings asset, okay? You can see that the US dollar was making up somewhere around 60 to 70% of the foreign reserve holdings of central banks all around the world. But however, in 2023, the entire world is de-dollarizing. They're trying to dump US dollars from their reserves, but more importantly, what they're actually doing is they're even trying to trade in other currencies outside of the US dollar. Now, I believe this is actually far more important than other nations dumping US dollar debt, because if they are actually able to facilitate trade or find a different medium of exchange, all of a sudden the US dollar is pretty much irrelevant, okay? So we have the BRICS countries around the world, all announcing that they are going to actually create a new reserve currency, and they're potentially thinking about backing this new reserve currency by gold. And this is significant because the BRICS countries today, so that is Brazil, Russia, India, China, and South Africa, they have a far larger GDP than the G7 countries do. So this is big because they are now an economic powerhouse and they hold a large majority of the commodities around the world. We talk about this a lot on the channel, so we're not going to get into it today. But this fracturing in the US dollar petrodollar system is very, very, very important because I believe it is the hints or the clues that this 2023 banking crisis could potentially be a lot different. Okay, now here's just a little bit of a hypothetical scenario for you guys. If the world is de-dollarizing, okay, and everybody's trying to dump their US dollar debt, is there one way for the United States to actually try to force dollarization on lots of countries around the world and try to force countries into using the US dollar because it's the least bad alternative? Well, what do you think about the United States' most aggressive interest rate hiking schedule of all time? Okay, the US raised rates from pretty much zero all the way to above 5% federal funds rates. And what that did in 2022 was it created the largest wave of global inflation all around the world that we've ever seen. So Turkey, Sri Lanka, Argentina, they all have inflation well above 100% now. And in all of those countries, you can see enormous demand for US dollars simply because it's the least bad alternative. And this also kind of ties into this Bitcoin milkshake theory that I do have. I believe that as countries suffer from this enormous inflation, you're going to see a lot of Bitcoin adoption, as it is a great hedge and a great store of value if you're able to stomach the volatility. But where you do see higher Bitcoin adoption rates, you will also see higher US dollar adoption rates. Because when somebody says, okay, I'm done with my Argentinian peso, I am done with my Pakistani rupee, I am absolutely fed up, I'm going to opt out with Bitcoin. When somebody makes this leap, they also start considering other aspects of their finance. And I believe they also do begin adopting US dollar stable coins alongside Bitcoin, just because they need something that's a little bit easier to use as a medium of exchange, especially in these poorer countries. So again, I think this is very interesting because is the Fed doing something different to the rest of the world? It's interesting because for the first time in this kind of modern fiat era, the United States actually said, you know what? We're going to go our own way. We are going to aggressively raise interest rates at the fastest pace we ever have in history. Now, what happens when the United States aggressively raises interest rates is it essentially bankrupts the world, okay? The entire world still operates on US dollars, and when interest rates are far higher, that means all of a sudden all of that US dollar debt that the entire world has becomes far, far, far harder to pay, okay? So this is what created this global wave of inflation, and this is very interesting because the entire world was not happy with this. We can see headlines coming out of Europe, which is supposedly one of America's greatest allies, okay? Europe is supposed to be united with America, but they were really not happy with this interest rate policy by America. You have to ask yourself, why? Why weren't they happy with it? Why did the IMF beg America to slow down their interest rate hikes? Even the World Bank and many of these other institutions like the WEF had some very interesting comments about America's interest rate hiking schedule. So what exactly did it mean and what exactly did it cause? Why was the world not impressed with America's interest rate hiking schedule? Maybe it's because of what it did to the rest of the world. It increased demand for US dollars. So again, I'm not going to engage in a whole lot of speculation. I'm just putting the facts out there. You guys can let me know down in the comments below whether you think I'm crazy or whether you think America is actually engaged in economic warfare against the BRICS countries and all of these nations around the world who are trying to de-dollarize their economies. But that is reason number 2 why I believe this time in 2023 is very different to the 2008 banking crisis. We have no global cooperation in the realm of economics. The entire world is trying to opt out. We have countries like El Salvador who are completely adopting a Bitcoin standard. We have lots of other smaller nations around the world who also have Bitcoin projects within their borders. We have countries like Brazil, Costa Rica, Honduras, even Switzerland and Portugal, some absolute mega countries over in Europe Europe, they also have little Bitcoin projects within their borders. So I believe the world is kind of going its separate ways. We are finally, for the first time in 80 years since that 1940s Bretton Woods Agreement, we're entering this deglobalized world. So I think that is going to throw up many curveballs that we're going to discuss later on into today's video. But I want to get on to the third reason for why this time is actually different. So let's quickly summarize what we've learned so far. Reason number one for why this time is not like 2008. The Fed is already doing QE. They're more proactive and not reactive, and they're handing out swap lines to the rest of the world, to the countries that they actually like, okay? So the countries that are bankrupt and they like, they're giving them US dollar liquidity. And the countries that America doesn't like, they're not getting liquidity, okay? So that's reason number one. This dovetails nicely into reason number two. We do not have global cooperation. The Fed is going its own way, and so is the rest of the world. Now, reason number three why this time is potentially different is because this time it's not the mortgage-backed securities that are the collateral of the system that are going toxic and losing a lot of value. It is actually the United States 10-year Treasury bond, okay? So the US dollar acts as the collateral for the entire world, okay? Most people would have heard of the Eurodollar market. We're not going to get too granular into that one today. All you need to know is there's banks all around the world who are making US dollar loans, and a lot of these banks hold US treasuries. And when they're giving out loans to other countries, they say, hey, look, we hold the US Treasury. This is the best dirty shirt in the laundry hamper, so to say. Give us a loan. We have the safe liquid collateral, but it is not so safe and it is not so liquid these days in 2023. We're going to actually play another Balaji clip that is going to help kind of get this ball rolling, where he is actually comparing government debt to the toxic waste of the 2008 global financial crisis, which were the mortgage-backed securities.
This is not just a banking crisis, it's a bond crisis. If mortgage-backed securities were the toxic waste in 2008, where they were rated AAA, but they were actually extremely unsafe, treasuries themselves are the toxic waste of 2023.
Balaji is calling sovereign debt the mortgage-backed security of 2023. And that's a fascinating comparison. And it's something I want to slowly pick apart for you guys, okay? So treasuries or sovereign debt of any nation state around the world today serves as the backbone for the entire global financial system. The entire shadow banking system in the Eurodollar market holds on to these US treasuries as collateral, okay? And central banks around the world are sitting on tens of trillions of dollars of sovereign debt as collateral and quote unquote safe reserves, okay? So this was very similar to what we saw in the 08 GFC, where these things called mortgage-backed securities were held as collateral and reserves for banks all around the world. And we only had that financial crisis when the mortgage-backed securities were found to be not safe at all, and everybody was holding that unsafe, toxic product. And the same thing is happening today. People are beginning to come to the realization that, hang on a minute, these US treasuries or these European bonds that I'm sitting on, they're not safe, okay? We have inflation at 50-year highs, and the bonds are only returning 2 to 3% yields on those inflation. So you are losing money if you're holding sovereign debt. And today, treasuries, as well as all of the other sovereign bonds around the world, are the toxic waste, okay? They are the mortgage-backed security. And now that is really counterintuitive and hard for most people to understand, because bonds have been some of the better performing assets over the past 50 years, when we have seen interest rates lowered from around 20% in 1980 to around, 4 or 5% where they are today. Bonds performed extraordinarily well, but this time is different because the macroeconomic environment has changed. We saw what happened only last year, okay? Bonds had their worst year in decades. The US 10-year Treasury bond, just for example, actually had its worst yearly performance since the 1770s, over 250 years ago. Now, the reason that the US Treasury performed so poorly in 2022 was because the US embarked on its most aggressive interest rate hiking schedule in history. Okay, let's remember our simple bond maths, okay? When the yields of bonds are going up, that means the prices of those bonds are going down. So as central banks around the world raise interest rates, bonds naturally sell off because the bonds with the low yields cannot survive in a higher interest rate environment. It's that simple. We're not going to get too granular, But I just want to move on and look at the inflation component of this conundrum that we're watching people face themselves with now that they're holding all of these toxic assets, okay? If inflation around the world is on average around 8%, I believe that is the global average of inflation, and the average bond is yielding you 3%, that means on average, you are losing 5% of your money holding these toxic assets, and the world is only slowly beginning to figure that out. And I actually have a 3-year list here that shows the number of countries around the world that had double-digit inflation. So inflation above 10%. You can see in 2020, there was only around 15 countries on that list. 2021, 17 countries, pretty much the same. But then all of a sudden in 2022, we can see that over 88 countries had inflation above that 10% Rubicon. And that is massive. And that is why the world is slowly coming to the realization that sovereign bonds and sovereign debt is the 2023 mortgage-backed security of this 2023 banking crisis. And this is exactly why the entire world is dumping their US dollars. It doesn't matter which chart you look at, the world is de-dollarizing and the US dollar is becoming a smaller and a smaller part of foreign reserves around the world. Yes, it is still being used a lot for transactions. There is a heap of US dollar debt out there. We're going to leave the nuance for another video. We're going to move on. And I want to look at something very important because it's not just the US government debt that's being dumped all around the world. It's sovereign debt of countries everywhere. Again, we can see that this issue is not solely isolated in the United States. This is an issue that is permeating the entire world because the entire world has inflation, the entire world has too much debt, and the entire world is not actually raising the interest rates on their government debts high enough to actually compensate for the fact that they are losing money holding that fiat instrument. And this is a fascinating chart that is tracking the yields on bonds versus the equity market. And we can see in the 1960s, 70s, and 80s, when the yield on bonds went up aggressively, what I find really interesting is stocks were relatively flat in the 1970s. You can see by this little area I have highlighted and I'm pointing to, stocks were pretty much flat for the whole decade of the 1970s. And that was despite the fact that we saw on average around 6 to 7% inflation every single year for that decade. So that means you have essentially had your purchasing power absolutely wiped out if you were holding fiat currency or even had your money parked in the stock market because you thought you were escaping inflation. So those are the 3 reasons why this debt crisis and this banking crisis is far different to any other 2008 style crisis that we have seen before. But I actually have a pretty interesting thesis that it's not only this kind of banking crisis that's different this time. I believe we're seeing lots of clues and lots of suggestions in the Bitcoin data that is actually indicating other nation states around the world also believe that this time is different. When you take a look at the mining hash power, the amount of coins on exchanges, and who's buying those coins, some very interesting things begin to pop up that we've never seen in any other Bitcoin bear market. Now, I believe these data points have some very interesting relationships to the 2023 BlackRock Bitcoin ETF filing and why they strategically released a 2022 written white paper where they indicated the best allocation to Bitcoin was 85%. If you want to learn a little bit more about the nation state prisoner's dilemma and why I believe this time is different, I think you're going to love the video I recently recorded on that topic right there. And if you want to learn a little bit more about why this time is different in the realm of the Bitcoin bear markets, you can check out the video I also recorded on that topic right there. And with all that said, if you made it this far, I hope you enjoyed this video and I hope you enjoyed the 2 videos I slapped up on screen right now, and I'll see you all in the next one.